let's just leave it at that. And in the meantime, I'll also start to stream in the Discord. So we'll keep
Yeah.
moving.
And when you stream, try to do it like maybe like 30 frames per second.
Stream 30
Um,
frames per second? Okay.
yeah. Sometimes I think what might be the issue with like sharing the screen, sometimes it's just like, for me, Discord has crashed when I try to go like 1080p,
Oh, I
60
see, I
frames.
see. So
Yeah.
just go 720, 30?
Yeah, that might be okay if that's
Okay.
cool with everyone.
Yeah, I mean, we can try it. We can just see how it looks for now. We got like a minute or two left. How's that look, y'all? I'm gonna full screen this. That's valid. I want you to
Yeah,
recap, but yeah, yeah.
it's looking good.
Cool, cool. All right, we'll just keep it at that, and I'll just also keep track of time here. All right, it's actually 8:05, so you know what? Let's just get going. The people are waiting. They're coming in, so if you guys are coming in right now, just a really brief intro. I'm Aman. I've been trading options for 4 years. I also been um, trading futures for like a year and a half now. In December, it'll be 2 years. So really, I am experiencing both, and I do actively have accounts with both futures brokerage and option brokerages, and I'm here to just get into it, distinguish the two, and also talk a little bit about prop firms later in the presentation. At the end, we'll go over questions. I'll answer any questions you guys want, but it's not too long. But let me just run through this and sort of spell this out for you guys, and we'll work from there. So. Without further ado, I'm just gonna hop into the presentation, um, and just kind of break it down for you guys. So today we're gonna learn about futures versus options. What are the differences? Why they're even valuable to us in the first place, right? So a lot of you guys, when you guys are onboarded, maybe you've taken Key's course, maybe you've studied a lot of Key's material. He does a really great job in breaking down options. And the thing is that options is just kind of one piece of the pie. In the greater world of trading, you'll understand that options is actually very niche. It's not something that everyone does, and the reason is because it's not as inclusive. First off, you have to have American bank accounts to trade the U.S. stock market, and then also, um, the regionality matters, and also people don't. Um, like nowadays it's pretty trendy, but back in the day it was not as accessible. Now that we have like phones and brokerages, it's gotten a lot popular. So in terms of trading, actually, futures and forex people, not the not the like the multi-level marketing scheme forex, but more so the people who trade currencies and currency pairs, like that's kind of the bulk of the entire trading pool, and you'll start to understand why as I go throughout the presentation. But I just want to open your guys' minds and open your guys' head, because there's a lot of opportunity to know about both and also trade both, and that's kind of what I wanted to break down. But also, if you don't like options, or if you feel like options is not clicking for you, I would also implore you to try futures, because that might be something that's more your style. So that's kind of what I want to get into today, and we'll break it down. So the thing is, options and futures both are known as financial derivatives. Now, there's multiple financial derivatives you'll see by the visual I provided here. Um, what's going on is there's two that we're not going to cover today. That's going to be forwards and swaps. They're not really relevant for us, but you'll notice that futures and options are also listed. And if you think about what derivatives are, it means that price of that asset is derived from somewhere, or it depends on something, right? In this case, like what is an options price based off of? Well, it's actually based off of the price of the stock, right? At the end of the day, that's going to determine if your option is in the money, out the money, what strike you pick, whatever the option the stock is trading right now. That's what's determining that option. So as a result, an option is considered the derivative of that stock. So a future is also considered a derivative of a lot of different types of assets. Actually, it encompasses more than just stocks traded, or publicly traded companies in the United States. That's where you get into oil futures, orange futures, chocolate futures, gold futures. That's kind of that area um, of trading, and I'll kind of get into why both those are really advantageous to know and take advantage of. So just give me a little bit of your time here. Hold on, let me progress. Okay, cool. So what you'll understand is I know a lot of you guys have traded options or experienced trading options, and I won't like harp on it too long, but really just understand that options is very unique. There's not a lot of assets that trade like it. That's also why we have introductory courses dedicated specifically for options, right? Um, the idea of a strike price, the idea of an expiration date, and also the idea of time decay is actually unique to options. Expiration date specifically is not unique to options, but the way you buy contracts and they expire at a weekly or monthly or even a daily cadence, that in itself is actually unique to options. So um, when we're talking about those features, that also can affect a lot of the price and the amount of money your asset is worth at any given day. So as a result, the option, when you purchase an option, it's inherently very volatile. What you buy it at yesterday is not going to be the same price it is today, right? There has to be a lot of factors that line up for it to do that. So my point is that options itself is sort of unique by all those things that we might have taught in previous academies, like the Greeks, the thetas, um, IV, and of course, just the traditional definition is that you're essentially betting on the stock. It's a speculation of what you think the stock is going to trade at. As a result, it becomes a derivative of that stock price. And that's really all you have to understand with options. And if you didn't understand that, like, you don't actually have to fully comprehend all this to trade and make money, but it's good to understand this because you'll understand why the value of futures comes into play. So why would you even trade options in the first place, right? If you have a certain amount of money and you want to make some money in the stock market, why is it that we start to recommend options in the first place? Why do we not recommend just buying stocks or penny stocks like we were talking on Twitch earlier? Why don't we recommend you to start in crypto and then take some money out and then put it into stocks and then trade some stocks and then put it into options? We don't recommend all that because there's significant advantages to trade options in the first place, right? Your leverage, the amount of capital you can control, like when a stock moves $2, $3 and you might make 40 to 100% on that option, like that is a lot of leverage or uh control you have over the movement. Also, the flexibility with options, you can be very, very simple and just bet on the stock going up, or you can be very complex where you're buying a call far out, or and then at the same time you're buying puts short term, so you're covering kind of both sides of the coin there. Or you could do something like butterflies or iron condors, or just even bet in a way that you're making money when the stock consolidates. So you have a lot of flexibility. Also, the hedging part is really, really important. That's actually the primary use of options. People don't trade naked options like us. People actually find that to be really risky. And they're not wrong. It is really risky. That's why we do a lot of preventative training around your risk management and what it's like to put stops and protect your capital. It is risky, but the thing is that what you can do is when you're heavily invested, let's say you bought up like 1,000 shares of a company, and that's where most of your money is, to protect your downside and your portfolio putting back too much. What you can do is contribute a little bit of your portfolio towards an option that would pay you on that downside, so you can kind of stomach or soften the blow when it comes to your port coming down, right? So that is the actual advantage of trade options. If you didn't know, that's why we are fond of it so much. That's why we teach it. And also, um, the actual idea of trading options is purely speculative, much like futures. So there is some differences and also some similarities, but I'm here to break that down. So let's go to the next slide. And like I said, guys, just like most assets, just like gold, just like real estate, just like buying a car, Just like buying jewelry, there's always a risk involved. You can lose money in both instruments of trading. It doesn't really matter. I also want to just let you guys know that trading options isn't inherently that accessible, right? In some ways, options is has a lot of artificial difficulty behind it. For example, like a PDT trading. I remember my first time trading with Robinhood. I got banned. I think like 90 days. I was so salty, and I didn't understand why because I was so active and trading and trying to protect my money that essentially they were just punishing me for selling, for taking my money. So I was like, that's so crazy to me that you need $25,000. Of course, there's a workaround. You can have a cash account, which is fine, but it means that you can't be in and out as much as you like. You have a finite amount of capital to work with every day because you're waiting on money to settle. So yes, options is definitely valuable, but it's not the best asset. In fact, there's no best instrument to trade. That's why, as a trader, as an investor, it's important to diversify yourself. That way, you can kind of extract the most benefit while kind of being exposed to kind of the same downsides, right? So, um, another thing is that time. A lot of people they learn about theta the hard way. A lot of people they learn about IV crush after swinging earnings the hard way. You know, um, there's things where you can't afford to hold it because the option is kind of in a position where it's trying to go belly up. It's more inclined to go belly up or go against your favor. Not only that, but in options, there's also a limited amount of time that you can commit to it in the sense that it's only open from 9:30 to 4 p.m. EST. Well, what if you work during those hours, which most people do? What if people have kids to take care of? Life doesn't just stop operating around 9 to 5, right? So that's something as well that people don't necessarily talk about. A lot of people can't afford the the luxury of just being at home or being in front of a computer all day just to even be present for the opportunities in the market, right? So that's something to keep in mind. Now, options, they actually cost money to open per contract. Now, if you trade on Robinhood and Webull, these guys are very clever in the way that they structure your options and contracts fees. If you didn't know, guys, like there's a reason that you can't sell on Robinhood or Webull at like 93 cents. It's always 95 or it's always 90. And the reason that is because they're pocketing that little difference. That's their pain. So, they label it like it's free, but in reality, they're just collecting a service fee, right? So like it's actually just not free at all. But something like TD will structure it kind of in front of you. They're saying, yeah, we're going to take this much per contract open. So my point is that no matter how many times you open or trade contracts, it's not free. You're still being taxed whether you see it or not. It's happening. Those brokers are getting paid. Like if there's one thing that I can guarantee is that you might not get paid, but the brokers are going to get paid. So just understand that you are getting taxed on your options as well. Now, liquidity. Now, what I mean by liquidity is not necessarily in the ICT stuff that I talk about all the time. It's not technical liquidity on a chart. What I'm talking about is when you trade options for the first time and you might buy an option and then you figure out that there's no volume and you're wondering why your position's not selling. You're wondering why no one's buying uh, your position unless it's at a heavy discount because the spread is so wide, right? Let me ask you this in the chat, guys. Press one if you ever bought an option and you couldn't sell it. Like it was just not liquid. You found out there was no volume or no one bought that strike. Has that ever happened to you? Unknowingly? Right? No one tells you about that, right? And it's because actually half of the options chains presented are not liquid. They're designed for you to lose. People write them knowing that you're going to buy them. Do you understand that when people write them, they collect a premium off you? So they get paid whether it goes to zero or not. And guess what? 90% of those options go to zero, right? So my point is that like there even though options is great and we all trade it, you guys know that there's a risk involved. You guys know that it's exactly like other assets where you can make a lot of money or you can lose a lot of money and fast too. So um, this is something that I want to address because I might allude to in the future that futures might have none of this. You understand? You might have not worry about none of that. So that might be appealing to you. Um, let's continue. So, I kind of broke it down or spoiled a little bit about futures, but let's start to understand futures, okay? We covered options. We all been trading options for a while. I know most of us, majority of us in the audience, that's what we do. That's also how I started as well. I've just recently started diversifying myself, so I'm right there with you. But you'll also hear me out in the sense that futures is kind of like what you see on this visual on the left here, right? You see the green up arrows and you see the down arrows. So when you're trading, it's kind of like you're just trading pure price action, pure what you see. You enter here and then you sell here. And the reason why I took this visual is because this is a really, really good example of what futures trading is actually like. It's not like you're going on down a chain and selecting any strike or contract or expiry. It's like you select an asset or a ticker, you bring up the chart, and then you trade the price you see in front of you, much like a stock. But you have that leverage that options can provide. But it's labeled differently. It's called futures, and I'll tell you why it's called futures. So let's understand it. Let's dial it back. I got kind of excited to be honest, but the the futures we're talking about is essentially all type of futures, right? When I talk about futures, I typically say, I talk about ES, I talk about NQ, for example. These are futures of indexes, amalgamation of stocks traded as one asset, okay? And these are typically market indicators, U.S. stock market indicators. Um, but futures is the definition of futures is pure speculation, what you think the price is going to be. So naturally, it could just be on anything. You can, like I said, you could have orange futures, you could have wheat futures, you could have corn futures. Like any asset or any commodity has a futures attached to it. So that's kind of what I mentioned here. The most common futures you run across are people who trade like commodities, oils, very popular, wheat is very popular, especially oil during wartime is extremely volatile because of course there's a lot of sanctions, there's a lot of political tensions going on, and so what happens is that oil can really shoot up in a lot of areas due to the summer sanctions, right? Like if you close off a trading route, or this country wants to sanction this country for doing war, well, oils might go up or down and you can make money off that. So that's kind of how people trade oils and futures whenever they're talking about that. In terms of financial futures, that's like the most basic thing. You can trade currencies like of course there's indexes, of course, like what I trade, but there's more further instruments of currency that you can trade, like betting on interest rates of certain things like mortgage rates, or just general like uh greater market interest rates, housing rates. You can bet on that by trading the stock. And you can also trade different financial instruments as well. Typically, when you go on future platforms, you can also get into those forex currency pairs, right? Like that is like the real core forex. I know it gets really muddled. The definition has been like so tarnished over, I guess, since COVID, ever since like people started getting those like recruitment forex groups. But forex is a real thing. It's just currency pairs, right? It's like USD to yen, or British pound or Canadian dollar. Just those currency pairs, those forex exchanges. Um, that's that's the same type of brokerage as like index or a commodity. They're all futures. So why would you want to trade futures in the first place? Why do we care? Why do I even stress, or why do I even recommend that people give it a shot or just understand what futures even is? So there's a couple things why you would want to trade futures as a trader. Here's the thing. There's no time decay. Yes, believe it or not, there's no time decay. Like, how many times have you guys bid in an option and um it's near expiry, it's going in a direction, but since it's so close to expiry, you're not even making money. It might even be at your strike or near it, but you're not making money. How many times has it happened to y'all? I can tell you right now that has happened like a million times for me, where theta has just pretty much destroyed any choice of profits I've had. And if that's not you, that's okay too. But what I'm trying to say is that when you're day trading, when you're doing short-term contracts, you might feel that effective theta very quickly. Okay, you have a stock return on you on a 0 day or a weekly, you're gonna feel that because your expiry is so low. Theta is oppressing that value. Okay, so why I like futures so much is that that is not even a consideration. I just pure trade pure price action. It doesn't matter what time it is. It doesn't matter who says this. It doesn't matter if GameStop's halted. It doesn't matter if, this contract expires Wednesday and I'm waiting for a move that's happening on Tuesday. None of that matters. I just played pure price action. Is the stock higher or lower than when I entered? That's all that matters. And the price and the profit you get is always going to be the same every day. So as a result, it makes it really easy to structure a trading plan and sort of build a regimen as to how you want to trade, how much money you need to take out the market every day to do this, do that. It's very hard to do that accurate with options and price options. That's also why there's so many tools that price and calculate options as well, because it's actually really hard to do that mentally. With futures, you can kind of just do that on the fly, and you can have a very, very clear understanding of how much to leverage and how much you need to make to be good every day. Now, like kind of like number two is sort of what I was leading into in the simplicity of pricing, in the sense that pricing is pretty straightforward. Now, if you guys don't know, the way options are priced is based off something that's called the Black-Scholes model. Okay, the Black-Scholes model is essentially this complex little equation that would price your option based on the strike or the current price it's trading at. Okay. Um, that's a very complex number. It's not really feasible to do mentally, but the simplicity of futures is that it's very straightforward. It's based off whatever the actual asset is, okay? If gold is this much, if gold is 1,000, futures might be 1,100, right? We're thinking a month out it might go $100. That's what they're saying. So it's very simple to understand where the price is being derived from, very transparent as well. Now, the standardization and liquidity point that I mapped number three is super super viable for people who'd like to trade options, because now there's no question of what strike should I buy, what you know, when should I hold this till? Oh, I hope this gets more volume, or oh man, the spread is bad. I have to sell at a loss now. None of that actually happens here. And the reason why that doesn't happen is because all these futures and options and commodities, they're all standardized. And so what happens is that when you don't separate everyone on chains and different types of contracts, everyone ends up buying and exchanging the same contracts, which makes it really easy for you to buy and sell very fast. In fact, when I trade options, it's actually instant. I don't even feel a delay. With Robinhood, with Webull, like sometimes you gotta mess around a lot or adjust your fill so much just because the screen or the product is so slow, just to react to something that's really volatile. So none of that happens with futures. You understand? So I just want to make that clear as well. And also, in terms of your implied volatility, there's no concern. Sometimes you can have an option go in your favor, the cards align, but there's no volatility. If there's no sense of um, movement or big momentum behind that option, and it's kind of like a slow grind, you still might get punished. You still might not make as much as you'd like. And so with futures, we just remove all that entirely. It doesn't matter if it goes up 30 points in 2 hours or 30 points in 30 minutes. That doesn't matter on futures, but it would matter on options. If you trade weeklies and something goes up 30 points in 2 hours, the profit is a lot less than if it went up to the 30 points in 2 minutes or 30 minutes, for example. So um, that's That's something that I'm telling you that futures completely removes. We don't have to sit here and theory craft about uh is this volatile enough? Is this gonna have enough movement today? This and that. None of it. We trade what we see. It's beautiful. Now, I'm intimidating you guys with this slide. I'm letting you guys know it's not all fun and games, guys. You still got to learn it. You still have to treat it as a different asset. Just because I'm giving you this example or giving you this presentation doesn't mean you ready to start trading futures only. I recommend getting your feet wet, very small, very slow. But we can kind of go into a lot of what we have going on here. I'm just going to zoom in because there's a lot of text, and I can just kind of work through a lot of these bubbles here. So first off, what makes up a futures contract? Well, the thing is, when you're buying a futures contract, it's not like you're selecting a strike on an options trade. What's happening is you're actually going into a chart and you're looking at up a ticker. This might be ES. This might be NQ. It might have a letter and also a date of expiry attached to it. So completely different already, right? There's no specific chain for it. So what you're doing is instead of buying um, one contract like an option, what you actually are doing is essentially buying an entry or buying your exposure to that stock. You're letting your portfolio be exposed to that stock. And I'll explain to you how that works. It's kind of abstract when I make the comparison, but when you get into trading options or even after this, I recommend you guys open a paper trading account on Robinhood or Webull, I think. They offer some kind of futures paper trading. I'm not sure if Robinhood does, but Webull does. I know that because I actually have that. I have that feature enabled on my phone. So like I sometimes will um, just theory craft, or if I don't feel like putting money, I'll try to take a futures trade just to keep uh, just to test theories I have and something I'm not like just to iron out edges that I'm developing. And so, um, what I'm trying to tell you is that a future contract just represents the underlying price. That's really all it is. Um, so one gold futures contracts can represent 100 ounces of gold, right? So it's very simple to calculate like the amount you've traded or the amount of capital you've committed to your position in the sense that, well, if you've bought in like four contracts, then you're trading X amount of ounces, in this case, 400 ounces of gold. So that's really all I want to highlight here. And it's not super important, just kind of like a definition. It's not something that you're going to leverage for trading. This one right here is definitely what you need to know, though. When does a contract expire? So a little bit different, right? Like there's no expiry date that you're putting out. There's no like theta or all these calculations. The expiry date of the contract is actually the ticker itself. And so, like, the contract is these different tickers and they all have different price speculations because they all expire at a certain quarter or a certain month. And so in this case, when a contract expires, that means the last day of September, this contract will expire. And this ticker or this asset is not going to be offered anymore. So then when September hits, the most current uh, futures chain is going to be December. Okay. So why that is that um, most of these contracts don't ever really get um, liquidated or like of course it's a contract, so yes, if you're wondering, you can technically execute it, but most of them, like 99% of them, don't. I've never executed it myself. I don't think I even have the option on my brokerage, the ones I use right now. And um, the reason is because most traders just liquidate, sell everything, or roll their positions before the next expiration. So people will already be trading December by pretty much half of like after the second week of August. The December contracts are really going to pick up, and you're going to see a lot of movement on that chart. So that's just kind of the nature of how futures operate. People are always and right. It's like I'm not trying to complicate things. It's very simple. uh like it's called futures. We're betting on the future price of the stock. Right? Like very very straightforward. um
Do you want to eventually like share kind of like the dashboard, maybe on Thinkorswim or something for like how it looks like and what buying one, like a futures contract looks like?
Yeah, I can. It's actually all, I have my brokerage set up on my laptop. I'm on my desktop
Okay,
sharing, so I'd have
word.
to just take some time and some minutes to like sign in and do everything. But I think I can just probably do that while we're answering questions and stuff.
Yep.
So yeah. So I think I can actually just probably bring up a paper trading on my uh trading view too. So I might you have to sign in. It's just because like I gotta download a bunch of shit like NinjaTrader and all this bullshit. But yeah. All right. Um, so something that you're gonna hear a lot when it comes to futures is standardization, right? And so your standardized just means like every contract size or every tick, every expiration is very, very similar across the assets. Of course, they do change depending on the assets. Like wheat uh, and oil are not going to have the same sort of count or the same sort of unit of measurement that maybe gold might, or maybe in this case index might, right? And just for example, just to give you an example, I think wheat is like calculated in bushels of wheat, and 1 bushel of wheat is equivalent to like 58 pounds of the crop. So it's all like arbitrary. And the thing is that for us and doing index trading, that itself is like mostly standardized. So um, yeah, I mean that's kind of like what you want to keep in mind, and it's really nice because once you trade one type of futures, you kind of have a taste for a lot of them. And the reason is because since they're all standardized, it's not like knowing different stocks and you know doing different dates, and this stock has a different expiry, this stock has like weekly contracts, but this stock only has monthly contracts. So just like it's nice to have a standardization where everything is the same and you can kind of estimate and do all this mental math on the fly. uh, so let's move over now. um, For the minimum tick size, this is something that you're going to hear a lot, actually. Now, there's a couple terms you hear. There's going to be pip, there's going to be point, and there's going to be tick. You guys might have heard that already, just because of the nature of like being trading futures adjacent. But basically, it's just a fancy way of saying the minimum price increment for a given futures contract. And so this obviously varies for assets. But for example, in this case, a tick is essentially represented um, on a U.S. stock market, right? A U.S. stock tick is actually it's actually 1 cent, right? Because the lowest value a U.S. stock can have is increments by a cent, and so in this case, a point is actually left of that decimal. So if a tick is to the right side or um, worth a cent, then a point would be $1. And so that's kind of how you can reference like uh, how sometimes I'll hop in, you know, Kia stream and I can say, hey, um, you know, a point like SPX dropped 10 points today. Well, that just means that SPX dropped $10. It's not that hard. Pip is actually very specific. It's synonymous with tick, but the thing is that pip is kind of used specifically a lot for forex currency pairs, and the reason why is because when you're talking to dealing with the difference in value of currencies, you're dealing with a lot of ratios, and so to express the difference between ratios, it becomes like it could become very very small. Like for example, like India's currency is like $1 to 80 Indian rupees or 80 rupees or something like that. I checked that a while ago. That's not accurate now, but similarly, a dollar might equal 100x or 100 something, 170 something yen. So that's why you get into pips. But for us, like typically points and ticks are going to be enough to really describe a lot of the movements. The reason why there's a standardization is because this you can use point and tick across any futures. It doesn't matter wheat or uh, index futures. It doesn't really matter. If you describe the points and ticks, we should have an idea of like how much you made or how much you lost. Um, Now, this is something I also wanted to get into as well. Is that much like futures has their tickers as symbolism, like basically what's happened is for futures they actually have their own sort of tickers and own symbolism as well, in the sense that Apple is AAPL and Microsoft is MSFT. For ES, ES represents futures for SPY, but they also have different sort of numbers and letters depending on the year and also the month that the contract is expiring on. Um, Now, honestly, I don't even know the full origin of like how a lot of these numbers are translated. Like, for example, U being September. Like, I don't know who made U for September, but I think it's just to like somehow just make them really really distinct. So that's all I can offer for that. I don't know the origins of the symbology, but they're just um, something that is different, and it's something that I had to get used to when I was coming off trading options. Because when you're trading options, it's like really easy to navigate all these companies. You can look up the type of the company name, you can do the ticker. But in this stuff, like it's kind of hard, and the reason why is because unlike the standardization of how the contracts are given to you across the brokerages and their symbols are not standardized. So different brokerages will have different names or like little slight differences uh in their offerings and how you look up the chart and stuff. So it just becomes like so cloudy and so like sometimes I would use a brokerage like Thinkers or not Thinkorswim. I use something called like Ninja Trader, and then Ninja Trader has different notation than let's say TradingView. So I just gotta like for some reason memorize both, So yeah, that sucks, but it's a small price to pay. But it's just something to understand that if you do end up trying to look for certain indexes, you might have to do a little bit more searching or just double check that you're actually trading that right contract, that the one that you intended. So yeah. Now, when you're thinking about futures, um, the the most critical thing is that the life of it isn't infinite. You can have a bunch of money in your futures account and you can hold a position for like a week if you really want. You don't have to sell ever once you buy it in. But it's not like a stock where you just hold it for months or years. It will expire based on the month that you bought it uh, within. And um, basically, like um, just understand that these contracts are designed for you to get in and out. Like if you want to swing or if you want to do something long term, trade contracts way far out, like offered in 2025, or just don't bother don't bother with the futures because you might get stopped out if you really swing for if you're really patient and swing a position for that long. So that's just something I want to give you guys a warning about. There's been times where the month ended and my position was stopped out and I was like, what the shit just happened? Like I just lost bad money. So I don't want that to happen to anyone. And just a reminder that it's not like options or the stocks. And I just kind of want to keep harping on that because when you trade futures for the first time and the only reference you have is the US stock market, it's not like that. It's not that reliable of a background. So yeah, it's kind of like a different beast. I'm just gonna zoom out again because those were all the points. But when I zoom out, it looks intimidating. That's why I said, it's not all fun and games. We gotta do a little learning before I really put you guys on. Okay, so now we have a little exercise. Okay, I'm gonna show you the real difference, the real difference between trading options and futures, like just a real life example, okay? So the nature, I just want to preface this with this, is that if you have $2,000 in your um, options contract or your options portfolio, well, it doesn't mean you're going to lose $2,000 of your portfolio that day, right? It's only if you risk all those $2,000 in a series of contracts that you're going to lose it all. But if you don't, if you risk 100, you're only going to lose 100, right? Well, I hate to tell you that futures is not like that. This is the whole caveat. Essentially, what I'm trying to explain to you is that when you buy or purchase or partake in options or futures, right? When you partake in this, what's happening is that what's it called? What's happening is that you're essentially opening your whole portfolio, your whole portfolio amount to the market, and all you are controlling is the degree of which that portfolio is exposed. Now I'll give you a real life example right here. I know that's kind of hard to visualize, so I want you guys to meet our friends. We have options Oscar and futures Frank. Okay, I got really creative with the naming here. So basically, what I can tell you is that uh, both of these guys are going to start with 2K each, $2,000 each in their account. And so both of these make a similar purchase. And by the way, guys, this is actually today's example. Like, this is actually the market move. This is SPY today. Just made a crazy, crazy move. And this is a really, really great example because I want to show you the real difference of what it's like to trade options and what it's like to trade futures. Now, in this case, when you are doing this in options, you might purchase a call, okay? And this call gonna expire a month out, and let's just say, hypothetically speaking, it costs $2, aka out of your pocket, 200, okay? You'll figure out that throughout the day, SPX or ES falls near 140 points. Unreal. Like it almost seems fake, but that's actually what happened today. And so let's say your options Oscar, right? And you purchase this at this price. You purchase a call, okay? Um, and this stock falls 140 points. What do you guys think happens? What happens to Oscar's option? Does he make money? What's the value of it? Does anyone have any idea? I'll wait, y'all. I'll wait. It's zero. Okay, maybe. Yeah, exactly. It's clapped. He's done. Options Oscar is just Oscar. He don't have any options anymore. It's clapped. Okay. So that's okay because yeah, of course it depends on the expiration, it depends on the volatility. But let's just say like yeah, that's why it's a great example. Like there's not really a debate. This thing fell 140 points. It could be a month out or a week out. You're clapped. Like you're not happy no matter how far the options out, right? So what I'm telling you is that he might lose that whole 200, but he still got 1800 left, right? Now, for futures, that's not the same game. That's not the same expectation you should have, okay? I'm going to go next. And I also want to talk about futures as well. Well, Alejandro's, he says, but tomorrow might go up 200 points. Yes. Well, Oscar is scared. Oscar's a new noob trader. So once he sees he got clapped, he's selling. He's done. Like there's no there's no faith in this guy. So the thing is that now Futures Frank, he's a different type of beast. Okay, Futures Frank says, look, I'm like options Oscar. Both these guys are terrible traders. They did wrong bets. Like they got no idea where the market's going, right? So they're like, I want to buy a call too. I want to buy in and I want to long this stock. Same price, same scenario, but instead of buying like let's say one type of contract, what I do is I just kind of click buy and I get this little arrow and I'm playing with the price on the screen. So what that means is that in this case, it's not like I'm putting up 200 in advance. I'm not prepaying. What I'm doing is I'm actually just opening my portfolio and every time it ticks a dollar down, believe it or not, that's $50 out my account. So if you can do the math here, That's why I have a crying emoji because there's nothing funny about this if this happens to you. And by the way, guys, there was a time in my futures career where I was a futures Frank. Okay, I got rugged. Like they just robbed me completely, one day. So I don't want you guys to be a futures Frank, but you can kind of guess what's gonna go on here. I'm gonna go to the next slide. Okay, what ends up happening is Oscar fails to close the position in profit, minus 200. Account stays at 1800. He's chilling. He comes back tomorrow. It's a new day. And like Alejandro said, we might make $200 tomorrow. We might just be back at where we started. No problem. That is the beauty of options right there. You control your risk. Now, Futures Frank, the reason why I made him this color is because he's already lifeless. Like, he's already done. He's already done. So, he's already kind of like a ghost of his former self here. And so, Futures Frank, he holds this long, all 140 points. And so what happens is that he actually fails to close a position in profit, similarly to Oscar, but obviously is he's in a worse position. If he were to withstand that account, if we were to withstand that kind of sell off, well, he would be minus $7,000. In this case, he doesn't even have 7,000 to his name, and so is what would happen is the brokerage would like kick him out at his last 100 or $150 and just say you're done, and they keep on the rest of the money. So that's why I have the rip emoji because that's the difference, right? You can't have all this freedom, all these amazing benefits that options has without understanding what future Frank had to go through. Okay, that's the whole point of why I even have this slide. Because when I tell you this, it's not gonna hit. Okay, it's not gonna ring. But when I show you this, now you kind of understand the picture. Okay, now it's a real life example of like it's a different beast. But as a result, as a result, it also happens on the upside as well. Let's say they either took a short or they're on the bottom and then they take the calls, so they're in profit. What's gonna happen is Futures Frank is going to make $50 every time this thing moves a dollar, no matter what. No matter if it's 12 afternoon, whether it's 3 an hour before the market closes, or whether it's 8 a.m. He's going to make the same amount of money every time. If he's right, he's right. You have to pay him $50 per dollar. In this case, Options Oscar, his profit isn't guaranteed. Why? It's because he has to worry about theta. He has to worry about if this has an earnings contract. He has to worry about if it's going to be volatile tomorrow. He has to worry about if there's even a proper bid and ask spread. If he's actually even near the money. If he bought a contract here, no one's even in his buying range. No one's even at the strike to offer him a good selling price. You understand? So that's the difference. It does go both ways, but I want to just show you that with with options, he it's a chance that he could make profit as well, but it's not as clear cut, right? I can tell you how much futures Frank can make, but I can't tell you accurately how much options Oscar is going to make. The reason is because well, there's so much variables. You guys said in the chat, well, it would depend on the expiry. Yeah, it would depend on expiry, it would depend on the implied volatility. It would depend on a lot of shit that we don't have control over. So that's why I want to expose you to kind of both sides here where well, maybe sometimes you don't want to deal with implied volatility or a lot of bullshit. That's kind of where I'm at. Where like, well, if I only trade like one thing, which is SPY or SPX most of the time, why wouldn't I just pick up futures? Why wouldn't I just pick up something that doesn't punish me for going in and out, something that doesn't punish me on the time front? I can just trade pure price action because that's how I trade my options, right? I'm very in and out. I'm very quick. I'm very um, attached to liquid chains. So what I want out of options is already presented in futures, right? And so that's kind of why I'm spelling out this difference for you guys. Um, so I hope you like that little that demonstration here. Uh, that was my own original art, so I know it's very creative. But now I want to talk about why even bother? We're a bunch of primarily, I think, options traders. Most of them has most experience in options. People might do crypto. People might do a little bit of futures already. But most of us have a lot of experience with options. And I know that's, we feel good about that's what we teach here at Teach Trade. But I'm the only one that offers some sort of things that can work for futures as well. Um, and so the thing is that there's actually a lot of reasons as to why you should try to give options a shot. And reason number one is that there's fewer transaction fees. So what that means is that, for example, if you want to trade options, you might get taxed 50 cents per contract opened. Okay, so if you buy 100 contracts, let's say, well, you end up paying a good amount in fees. Now, for the um, for the future side, it's typically one or two to five per contract. But the thing is that since the contract is a ticker itself, that means that you could open up like, you know, 10, 20, 100 times sort of leverage or exposure, and you're still getting priced at same $1 to $5, right? So if I make like $600 on an options trade, that $600 is actually scaled. And so what that means is that if I make $1,000, I'm getting I'm paying more than I would um, in fees than if I took $600, right? The taxes are scaling with your profit. So the more profit you make, the more taxes you pay. In futures, that's not the case. It doesn't matter if you win or lose, the price is always the same. And so, why that's advantageous for you is because over time, you're actually paying less money, less transactional fees if you're winning, right? It doesn't matter if you're making 600 to 2,000 to 20,000, you're still paying that same $1 to $5 per contract. And if you make $2,000 and your fee is $5, let me tell you, that is unreal. Like that's such an amazing deal. Like there is not a lot of things in today that will give you that little fee, right? If you make $2,000 from everywhere on the internet, some portion or some provider is taxing you from it. So I can just tell you that you have lower transaction fees when you're engaging in futures and stuff like that. Um, Another thing is that you have extended trading hours. Futures markets operate actually 23 hours a day. Yes, 23 hours. Okay? It allows trading and profit taking and exposure to the market outside of regular stock market hours. Okay? And so for you, I understand now some of you guys will just be like, okay, well, I'm just never going to leave my computer. I'm just going to trade all fucking day long. And I'm going to make infinite money. And so I can tell you that don't do that. Don't recommend that just off the bat. And the reason is because when you're starting out trading futures, that is, and you're coming from options, you're gonna get this taste of this new freedom of how in and out and how liquid you can be. And I think what's gonna happen is you will end up clapping yourself just from having an overexposure to futures. So just understand that if you're gonna trade um, the extended hours, the way you take advantage of that is that if you have a 9 to 5 and you work in a job, trade the 6 to 8 a.m. session, trade the 11 to 3 a.m. session. Make it work for you. That's the whole beauty of futures. We don't have to sit here and theory craft about trading the next day in the stock market if we missed the open or we came back and it was closed or something like that. Like we don't have to do none of that. We can just trade when it works for us because futures is speculation. Price speculation can happen whenever, right? Like we can bet on what the price is going to be whenever. It doesn't depend on when the stock market opens. So that's the whole difference, and that's the kind of the power of futures where not only can you just trade whenever your time allows you to, but now like when it comes to traveling, when it comes to working remote, when it comes to being in different time zones, you can maximize your exposure to the market and optimize yourself as a trader. Now, instead of being sad that you missed 100 points during the day, well, you don't have to be sad because the market's open 24 hours. You just log on to the futures and wait for another move if that's what you really want to do. I don't necessarily prescribe that without having a plan, but my point is that it's such a huge advantage and such a huge benefit that we can just trade whenever the hell we want. But I'll say that use it sparingly with great responsibility, or sorry, fucking what with great power comes great responsibility. And what I mean by that is just like pick a session, pick a limited amount of times or limited dedicated amount of times that you're going to be exposed to, and stick to that. If it's right after your work, if it's before your work, and that works for you, keep it at that. Don't be on 24 hours a day. That's not healthy. You're not going to make good decisions like that. Okay, so just take my word for that on that one thing. Now, another thing is that you can also respond to global events better when people are shot at, when things are happening on the weekend, when uh, natural disasters occur, when war breaks out. All these things are terrible. But who's to say we can't make a profit off it? You know what I'm saying? Like everyone else does, all those companies do, all those politicians do. There's no reasons as to why we can't have the opportunity or the exposure, if we so wish, to actually engage ourselves in those opportunities. And so when it comes to having that flexibility, you're only going to see that with futures. That's not possible in options because, well, I mean, of course, news flies definitely after 4, but the stock market sort of has a luxury of having breaks, but that's not the same case with futures. So you always got to be on, and you can be exposed to the market at almost any time you wish. So yep, just to keep that in mind. Another thing is that I mentioned this earlier. It's very high liquidity, and meanings there's never going to be an instance where you let a contract expire to like um, completely worthless, or no one wants to buy it. Like people will buy it and people will sell it instantly. If you're not getting filled instantly, there's probably a problem with your connection to your brokerage, not necessarily the actual uh, instrument being like not liquid. So that's just a reminder. It's definitely like a luxury because, of course, I trade SPX and SPY on Webull and options trading chains as well. But the thing is that for um, for being liquid, that definitely serves its purpose well. But there's been a lot of times where I look up individual stocks and sometimes an options chain a month out or 2 weeks out, it just has no volume. Like people are not buying shit. People are not even interested in what the stock is going to look like in a month. So there's never any sort of discrepancy on that front. Now, for number 4, what I'm talking about when I say simplicity and transparency is that it's very direct as to where the price is coming from. And so if ES, which is SPX futures, is derived from the index SPX, that's all there is to it, right? So if SPX goes down $10, you can bet those futures are going to come down $10 too. And it's really that simple. But the reason why that's advantageous for you is because even if you are not trading SPY, always still reference the futures because SPY is closed after 4. And so you don't get any of the information, you don't get any of that data as to the levels it was trading at when you were asleep or when you close the stock market, like when you close your screen, right? When the stock market closed. So even if you're not trading, um, even if you're not trading like futures specifically, referencing futures is going to be very advantageous for you, especially if you're trading indexes on options trades. And the reason is because trading futures is essentially the most up to date, it's the most live um, reference of price you could get because everything is derived off that futures if you think about it. If people are speculating what SPX is going to be in a month out or 2 months out, that also will control what SPX is at. And so with SPX is an amalgamation of the top 500 uh, worthwhile companies in the stock market, then that also controls the value of that stock, of those stocks, right? You ever seen those tech stocks move exactly with SPY? Well, there's a reason for that. So kind of getting down to the source price, the price that is controlling everything is going to be really easy for you to make decisions, right? Like I don't like to trade in the opposite of E- SPY futures, for example. So if I have an individual stock and I know it's like relatively well known. It might be, and that might not be Apple, but it might be something like Zoom or Uber, something that or Tesla, something that's in the S&P 500. Of course, I'm going to reference SPX futures, which is ES, because price is being derived from there. So that's the whole point of trading it in the first place is that if you're going to derive all price from there, you might as well just trade that, right? So that's kind of what I'm getting at here. It's just very efficient to um, understand like how NQ or these indexes have an influence over the market and over just individual tickers. So yeah, and then also your capital efficiency. Now, I'll say futures are relatively efficient to be exposed to. It's very similar to options in the sense that you don't need a lot to play with to get started, and it's similar to options where your like your profits are uncapped. And so like if you do have those days where you trade futures and the stock moves $100, well, you could just collect all that money, right? It doesn't matter if you're in the money, out the money. Like your theta and your price is not going to change dynamically as your stock moves closer to the money or to your strike. What's going to happen is you're going to make the same amount of money every time. And so that's really, really efficient. And also, what happens is that when you're comparing it to options, the average person doesn't even have a cash account, so they have to do the swing trading that he does. They have to do, they have to wait to sell a lot of the options at least one business day. But what happens is that when you're doing futures, there's none of that. So I can just buy, sell, buy, sell, buy, sell, buy, sell, and be done. Like I can just go in and out. I can go in, hold it for 3 hours, and then out. I can do whatever I want. There's no punishment or no sort of like cap or artificial limit as to how much you're going to trade. Um, what you can do is just simply you know if you're making money and you have the money, trade as you please, right? So that's all. Now, the follow up to this presentation is the prop firms. People are going to ask, what are prop firms? Why do I keep seeing prop firms when I have talk about futures? Well, I'll kind of explain what it is and I'll give you a summary of my thoughts right after and what I would advise as a new trader and how you can kind of take advantage of it. Because normally I would, to be honest, I would actually just try to stay away from prop firms, and I'll tell you why towards the end slide. That's kind of my attitude towards it. But I have no interest in not teaching you guys, and I also have no interest in keeping knowledge from you. So if you have the decision making to want to take up prop firms, more power to you, because there are, just like everything else, just like everything in this world, people can make money in a lot of different ways. So people make money off prop firms, that's true. People make money off options, that's true, and people make money off of futures. So it's not necessarily what is going to be the best. It's just what's the best for you. What's your preference? What's your lifestyle like? What's your availability like? What's your capital like? How much money are you willing to put down? How much money are you willing to lose before it gets uncomfortable? Stuff of that nature that really only you can answer yourself. So that's kind of what I want to get into here. And I'll start off by saying prop firms are just proprietary trading firms that provide you, the trader, capital, aka money, to trade on behalf of the firm. As a result of trading on behalf of the firm, what they will do is um, either give you a profit split, give you a portion of what you've earned, or they might reward you in other different types of compensation as well. Maybe they might give you affiliate deal. Maybe they might give you some sort of full time position where you're like a call out guru type guy. So And there's a bunch of stuff that people do. Proprietary firms are actually all over investing spaces. They're all over economic and financial spaces. I just recommend you know about them just so you don't have any questions and you're not baited and led by the wrong people. So I'm just going to break it down to you guys. I don't need to sell you on any of this stuff. And that's also a big thing, guys. Just if anyone is like selling you on like call outs or how to trade or anything like that, I don't know if they're really reliable because like a lot of the stuff we're doing at Teach.Trade is just because of our own jurisdiction, our own love for the community and all that stuff. Like Key and us, like we know each other offline and stuff. Like we don't really have to do all this. We can just trade together and trade separately and whatever. Like we're pretty self-sufficient, and so that's why we don't really want to like uh take uh, money or sell you things that we don't put like our heart and soul into or things that we don't think are actually of value. So, like I said, I'm just going to be giving you like flat out no sales, no bullshit of what I think of prop firms. They're good and bad. So, that's all I can say. Now, there's a bunch of types of prop firms. The most common prop firms you, as a trader in the modern day world, are going to run into futures and speculative futures trading firms. And I'll explain what that is. But there's a bunch of different types. So don't be blindsided when you look up prop firms or something. You say, well, there's a bunch. Like you didn't say this. Here they are. Okay, there's online remote for real life brokerages and real life hedge funds that you could apply and compete for positions for if you really know some people. Um, I wouldn't do that, but that's different strokes for different folks. Forex, specifically forex pairs. There's people who do this dabble in stocks. There's people who dabble in options, prop firms, and also futures trading as well. Now, here's the thing. Here's actually how these things work. Now, what they do is they will give you a significant capital. Like I'm talking anywhere between 50 to like half a million, like 50 to 500K, right? Um, they will give you access to these funds, quote unquote funds, because some of them are simulated, some of them are real. Most of them are simulated nowadays because you have to really prove yourself to get actual access to real money. But um, most of the simulations and most of the things you guys will run into are going to be simulated accounts. But basically, what that means is that your capital or you're trading with 150K, 75K, 50K, 300K, and they will give that access to you for a fee. Your fee usually comes in either an application or like some sort of like challenge where they try to get you to trade pretty well first to see if you're ready, and then as a result, like you pay for that entry, you pay for that tryout, and then once you win or once you complete some of their standards, then they're going to give you access to that big 150K account. Okay. Um, Now it does that sounds nice, but I'll get into why it's not actually that nice. Um, so now, in terms of how they're making money, they make money two ways. They make money off of selling your guys' trades. If you're really a wavy trader and you have a 100% win rate, which no one does, but if you're really super wavy and you trade with a stock firm long enough, they will just copy your trades or make some algorithm or try to sell your trades as money. And since you're so proficient with them, they can just monitor all your trades and when you take them. So they have no problem in profiting off of you. Another thing is that um, they'll also do a profit sharing model as well. If they give you real funds, what they'll do is that let's say you make a certain amount of money, they might take 80, they might take 70, they might take 90, they might take 30, they might take 20. It depends really what your share is, but your sharing level is. But basically, they'll take a share of how much you've earned. If you earn $10,000 and they take a 20% cut, then you're gonna walk away with 8,000. Okay. And the reason is because you leverage their funds. So that's kind of the tax that they're working for. And then also, they just make money off of selling those challenges because you have to actually be a proficient trader to win that challenge. It's not an easy challenge. I was able to get funded off of one brokerage on a proprietary firm called Apex Trader Funding. Their challenge was relatively easy. Um, because I say it's easy because there's not like a lot of drawdown or a lot of things that would stop me out if I play relatively conservative and relatively safe. But a lot of noobs can't do that. And also, I failed. I got stopped out my first two challenges before that. So it's like, even I had like years of experience with options. The futures trading challenges are not easy, and they kind of fall under the same guise that Taylor doesn't like to do, like specific uh 100 to $1 million challenge. It's because it's not sustainable. It just forces you to trade when you don't want to trade, right? So that's kind of like how they gatekeep a lot of the accounts. They'll say, here's a 100K account. It's a simulation account. What you have to do is actually take you'll have to take like, how can I say, you have to take like some precautions. So yeah, that's what I'm saying. Like, there's just like a lot of ifs and buts for the futures thing. But what I'm telling you is that when you're applying for one of these challenges, let's say you got a 100K account, they're gonna say you need anywhere between 6 and 9%. So if you can manage 6 or $9,000 between that profit on that 100K account, then what you can do is actually get access to the real account where you can start making money. Okay, and so that's kind of like how they gatekeep the locked accounts. You don't just pay for it and get it. Um, and so, and also, just to answer your question, have I ever had issues with payouts through Apex? No, but your first payout, they'll wait a month. They make you wait a month, so you just have to wait. You'll have a payout pending for a month, and then you'll start to get withdrawn and paid on a regular basis. But for the first payout, you're gonna have to wait a month, and that's something they don't tell you until the first time you try to take out money. So, but basically, um, the thing is that um, when you're forced to like make $6,000 or $9,000 within like a week, 2 weeks, or 10 days, or whatever the hell they say, essentially they're kind of setting you up to fail, because essentially you have two options. You have to either risk it for the biscuit and take a large position and try to get clapped the same day, or just be a hero and pass your options in the same day, or what you have to do is expose yourself a lot every day for like 10 days, and slowly, tickle on some profit. Now, for me, it took me 6 days to pass my challenge. So I did the slow method, okay? So I took a little bit of profit every day. And the reason is because you actually only have a max, or a lot allotted amount of contracts to leverage. So, like, just because they give you a 100K account doesn't mean you can throw in 50,000 of that 100,000 and then just like expect like 1 or 2 points and say, "Hey, I made $10,000." You know what I'm saying? I'm wavy. No, it doesn't work like that. You gotta play within their limits, and that's also why, like, that stuff starts to become not worth it. And I'll like really explain. Like, you're gonna see a more better example of it. I'm just kind of chatting with you guys. You say, how does a trade go? Do you have to make so much per trade? The trades are fine. It doesn't matter. It's a limited amount of trades under a certain time period. It's like 10 days or 2 weeks. But they're different. So like, my first trade I made like $200. My second trade I made like 600. Then I lost like 800. Then I made 400. 8,000. 6,000. So of course, my leverage is different all those trades as well, right? So my point is that I messed around with it long enough to get funded and all this stuff. That's why I can sit here and like tell you guys where I'm like, all right, guys, it's not really that worth it. Because if you're really that wavy and you're super sick at trading, you can just pay yourself. You don't need to play these games. You understand? That's the real reality. Um, but there's a benefit to playing with this too. The risk management is really nice. The reason is because it sort of teaches you a regimen, or it forces you to structure a lot of your trading. Like, leverage only. People say like, oh, leverage half a percent, leverage a percent of your account. It means that if you have 100K in your account, you're only risking $1,000 max per trade. Some people might have a drawdown, or they might have can only lose like $3 or $4,000. So that might be a lot. So I would even say, don't risk a percent, risk a quarter, risk half a percent. I usually risk a quarter, or point 20, or like 1/5 of a percent of a 100K account. So it's like, yeah, I would say, that in itself is kind of an advantage, in the sense that, like, if you want to play big, or if you want to make, like, let's say, some thousands of dollars, well, you could risk that with options, or you could just pay or apply for like account, a big prop firm account, and then if you're really wavy at trading, the max you'll lose that month is like whatever your account subscription fee is, and then you'll just have access to unlimited profits if you play right. So that's all. That's one thing that I would say is good. I see some people are typing, people are getting their questions in, so I like it. There's a lot of interest that starts to peak where when I talk about this, but it's good and bad. So I wasn't going to show it too much. There is advantages, and that's why they're still around. That's why the surface exists. Um, and so the thing is that there's a really nice access to capital that most traders don't have, especially people who are starting out. And so what happens is that like when they're when they're sitting and they want to make $2,000, $4,000, $8,000, a lot of people can make that off of just leveraging a small uh, prop firm account, and their risk is just buying that account. And so it's really incentivizing for them because to get a payout will just justify that whole procedure of applying, going through a challenge, and then also you know um, how can I say you know getting that first payout. So yeah, I mean, of course that profit sharing model is really nice as well. Now typically the profit sharing model is not really that great. It's not the moneymaker. They're still gonna like tax you 10, 20. I've even seen as bad as 30%. Um, Obviously that's not fun. That's not cool. No one likes fees. No one likes additional money that they're not going to get. But what I will say is that if you're really wavy and you do get a payout, sometimes you can fund the next 2 or 3 account challenges and stack more of those accounts. And what you can do is then you can actually enable something known as a trade copier that will mirror your trades and your commands across these different brokerages. And the thing is that basically what you can do is that for trading that one account to 2,000, you might multiply it by 5, and then you might take out $10,000 that month for an investment of just owning those prop firm accounts. So that's something that I think is actually viable. Like if you're really wavy, if you're really good at prop firm trading and you like it, you like the environment. Um, the thing is that like that could be an advantage. And I will say that, um, like, I kind of respect you more if you do trade copy or if you're trying to get into it because if you just trade one account for prop funds and stuff, I could probably like compare statements or just talk to you guys and like just show you how much I make with options or like my futures account, and I could just justify like similar levels of profits without paying for um a prop firm. So like that is the justification. Like, like I just made similar money without the prop firm and way easier. Like if Apex Trader Funding holds $3,000 for me in a month, it's like, well, when I trade options and I make $3,000 and I use my own money, I take that shit out next day. You understand? So like I don't have to deal with this if I'm just really wavy at trading. And that's what I want to just keep reminding you. Like if you're super proficient at trading, then prop firms are not going to be super appealing towards you because when you have your own money, you just do what you want, and that's not the law. That's not only the law of trading. That's kind of the law of life. You understand? And so, like, what I'm telling you is that if you're really proficient at trading and you're not trying to stack your prop firm accounts, it's probably not worth your time. And I'm kind of just telling you that now. Um, because I don't want people to get roped in, and I don't want the good people of Teach.Trade, to like get exposed to futures from me, and then they start looking futures things and YouTube videos and stuff, or Twitter people, and then like they're all selling them on courses, or they're all selling them on like stupid shit, like you know, I'll sell you this past funded account, like just like stuff that is gonna waste their time, that's not gonna enable them. So that's kind of why I want to keep it real with you guys and say even though I have passed and made a deposit out and I did get paid, so I don't have bad feelings about it not being legit. I just don't think it's necessarily efficient. I don't think it's necessarily the best option. I would argue that instead of paying like 1,000, or instead of paying $200 to have a drawdown of $2,000 to $5,000, just save up or trade yourself to that $2,000 and put that in and start to trade your own futures. That way, you can have a little bit of leverage and you can actually get a real exposure to managing a futures account, not something that is protected by a drawdown because it doesn't help you in the long run. But like I said, that risk management stuff is still real. It's it's that's one of the few advantages I do like. When you're starting out and you want to risk a little bit, maybe you want to invest yourself, go ahead, buy one or two challenges. But if you can't pass it, and I would say if you can't pass it in less than 10, like all that money you would have spent on those challenges, you might as well have just thrown it all into a real futures account, and you probably would have made money uh, one of those days, instead of just trying to play under other people's circumstances. So yeah. Now, joining a prop firm. I kind of already went over this because some people have already experienced prop firms and stuff, but this is kind of an example of what a prop firm offering would look like. I lifted a screenshot today, so it's pretty up to date from Apex Trader Funding. This is the reason why, because I used a 100K full account, and so basically that's why I kind of mentioned that 6 to 9,000 profit because those are the accounts. I actually failed the 150 twice, and then I got the 100. But basically, um, so you know, and what this is showing you is kind of the offerings of the accounts, right? And it's not like this is what I'm telling you. It's not like you get 100K and you can throw 50K into that shit. The max you can throw is 14 big contracts or 140 micros. Similarly, 17 or 170. That means you can be exposed to 14 contracts when you're trading index funds, for example. So that means the max you can be exposed on that 100K account is like every tick or every dollar you move, it's like 14 times 50, right? So in this case, 50 times 15 is like what? It's like $150 per. Or no, I'm sorry. It's like $75 per tick, $75 per dollar. So like you know, in 10 points, you moves 10 points, you lose like 30% of your account almost. 10 to 20 points, you might lose 30% of your account. And so basically what that means is that you start with this 100K, your profit goal to get money to start taking out profits is 100K, okay? Or sorry, it's 106K. So you got to make 6K, but you can only leverage around $75 per point, okay? So you actually got to make good trades. You can't just you can't cheese it. You can't put 50K and move a dollar. You can't cheese it like that. What you have to do, and you also have to be respectful, excuse me, you also have to be respectful of the trailing threshold. This is how you fail the accounts. So this is the caveat, right? When you have 100K, it says you can only have $3,000 for you to lose. Okay. So what that means is that if you start at 100K and you go below 97K, you fail the challenge. You don't have access to 100K anymore, right? So for what this is like good for is it's essentially saying you're paying to have like a $3,000 drawdown. I would argue that like a lot of people have made over $3,000 in options, and like I don't understand how losing $3,000, especially if you leverage more than that, is going to punish you in any way. But that's the thing that they have set up, right? Like that's the thing. When you have your own money, when you're trading for your own portfolio, none of these drawdowns actually make sense. It's all sort of just a game or all sort of a standard that these guys have came up with to supplement their business. That's really all it is. But I just want to, kind of let you know so you're not um, blindsided by this. And so there's going to be a skill assessment where you have to pass these challenges. Excuse me, hold on. And there's going to be also, you might be offered on Twitter or you might watch YouTube videos of people trying to offer training specifically to press these challenges. A lot of those guys might not be trustworthy because they might be affiliated with other brokerages. Don't go into trading programs for specifically passing these prop firms. It doesn't teach you a realistic good way of trading. Okay? It's artificial. You don't have a real life example of this money leaving and gaining your account. Okay? So it doesn't there's not much to learn or gain from it. So I wouldn't recommend investing anything in people or businesses that say we can train you up and we can make you pass this account for sure. Um, I wouldn't do that. I would just recommend just getting better at futures as a whole, getting better at trading as a whole, and then maybe you can attempt this. Okay, that's all. Now your performance evaluation is going to be different because you're different. Uh, your profit for the contracts is going to be depending on how much you actually pay for these accounts, and they're not cheap. Like $300 a month, $200 a month. Like these are relatively the same price right here. 200 and 200 close to. But my point is that there's fees, and so when you don't pass, you're still paying this. It's a loss. You understand? And so I would argue that if you lost $200 in futures, you'd probably learn a lot more than just losing $200 on a trading thing and just trying again. And the reason why is because, well, if you lost $200 of your own account of out of futures account, your own money, you're gonna remember that. It's gonna sting. It's gonna leave an imprint on you. Okay, and that's the whole value of. That's kind of the beauty of trading. It's like you don't really learn anything when you're winning, right? It's because you're rewarded. You're kind of validated when you're winning. The real learning, the real takeaways come from pain experiences. When you get clapped, you say, God damn, I'm never doing that shit again. And you have to figure out why you got clapped. So, that is the essence of trading. And because that is the essence, a lot of this stuff doesn't really, uh, float well with trading. So that's all. Let's go to the next thing. Okay. So in summary, I like to just kind of end this with a critical thinking aspect where I say, all right, guys, let's just sit and think about really what we're going to use prop firms for. There's really nice capital access, okay? Um, but And there's also a nice advantage with the trade copying. Like if you have multiple accounts and you're really hitting your trades, it's super duper profitable for really not a lot of risk. Like if you have access to 3 or 4, 100 or 200k accounts, and you're pulling like 8k profit a month per account, you're only risking like $1,000 a month to do that. You understand? To get like 30,000, 20,000 in your account. So if you're willing to really go crazy like that, then you need to you need to do that and you need to come here on the stage and put us all on. You understand? But if you're not, then I just wouldn't invest a lot of time into it because I know people ask me like, "Oh, what are prop funds? What funds do you recommend? All this stuff, this that." The reality is I don't really recommend a fund. I tried it. Do I think it's better than my own money making options or futures? No, right? Like nothing. I don't think a lot of things I do pays better than that. So that's all. Um, and that's just kind of like a personal thing. It's because I've invested a lot of time into becoming a proficient trader where I'm okay with risking my own money. I'm okay with putting my money where my mouth is, right? So that's all. For people who are noobs or people who cannot afford that sort of luxury and people who want to still develop the skill, this is for you. This right here is valid because it's what you take out of it. I'm just telling you the things that are not going to help you. You understand? Um, so for if you let's say you actually are interested, I know people are going to get try some actually. People are going to get funded, and I'll be happy for you when you get funded. The thing is that there needs to be what I recommend is you get your 1 or 2 payouts. It's like it's a good payout, and um, what you can do is like start your transition into a personal account. If you're able to pull out $2,000, $3,000, which is not that unrealistic with like 100k account, for example, if you're willing to pull that much amount out, like take that $2,000, $3,000, stack it, or just take that $2,000, $3,000 and go open a personal futures brokerage account. And what you can do is just trade micros, which is essentially uh, like the amount of regular futures divided by 10. So if 1 point or one tick is $12, one tick on the micros or is $1. So you have way more control and way more boundary of like how much money you can lose. So that's what I truly honest to God recommend. Like that's my personal recommendation. Like you get some prop for money, you tight on money, you know what I'm saying? Like get your challenge up. You really wavy at trading. You think you got what it takes. Buy your challenge. Pass that shit. Get the payout fat as soon as possible. Take that money out. Never ever go back to that prop fund and begin your true futures journey. That's all. Like literally just rob them and don't put your money back into them. That's what I that's the most efficient play. The most efficient play is to rob these businesses and do not cycle your money back with them because once you cycle your money back with them, you'll start to notice that it acts like a casino and they have an edge all the time. They get paid no matter what. When you win or lose, they get paid, right? So that's kind of like what I want to advise with you or advice to you. And so, summary, prop firms are excellent for gaining experience, yes, and building skills, yes. Both are true. But trading with personal funds offers greater independence and financial rewards in the long run. So, as someone who is genuine, my genuine approach is that in the long run, I would want you guys to actually come stay away from prop firms. So I'm not trying to hate and be like, don't do it. Do what you gotta do. But in the long run, just know where we stand because it'd be disingenuous to actually tell you to keep doing that shit, right? So that's all I want to lead with that. And then that's actually it, guys. That's actually the presentation. I appreciate you guys here. Um, what you guys can do is just stick around. I think I'll just try to open my trading view and you know, I can just show you like what it's like to execute an option or a futures real quick if you guys want. Uh, but yeah, how does that sound, guys? Are you guys pleased? Did you guys take away from some shit? Did it clear up some shit? Any questions? Press one in the chat. Let me see some reactions. And also, if you guys have questions, type them in the chat right now. I'm still here. I'm probably still here till like 10. You know what I'm saying? Maybe I'll stay around max half an hour. But you got questions? I'll answer. I'll talk to you. I'll talk to you about my trading experience as well, if you guys want. But I'm open book. But in the meantime, I'm gonna stop sharing this, and what I will do is I'm gonna. Do you guys see my trading view? Do you guys see how I switched to this? Okay, cool. So someone requested to speak. Uh, hopefully I don't regret this, but I let me see. Okay, I guess they. Oh, best prop firm. Okay, I can only speak for two firms. Apex Trader Funding. I can tell you, I got paid from them. I had to wait a month for my first payout. I did not like that shit. I don't want to trade with them again, but they're legit. They do pay. Apex Trader Funding. There's another one that's really more famous. That's more legit. It's called Top Step Trading. Top Step Trading is like kind of like the hot shit. You know, it's like the new trendy. It's like the most like recognizable prop firm. They do payouts as well. So those are the only two I can verify that either I know people who got money out of it or I got money myself. So that's all. And so there's another question as well. I'll run through it. Stick around, guys. So there's a question beforehand, and it says, "How much do you need to open a brokerage or trading futures and stuff?" So there's actually different types of brokerages. Okay, like different brokerages have different offerings. Typically, you need like 11 or 12,000. Like you'll need 12,000 money, like $12,000, and what will happen is they not might need like 11,000 of that as leverage. And so what that means is that if you get clapped, like they're gonna sell everything and leave you with $1,000. Like that's what that means. Is there a platform that doesn't require 25K for a cash account? Yes, there is. Okay. There's a platform. You see my screen, guys, right? You can see I opened up a browser. There's a platform called Tradeovate. Tradeovate is wavy. Let me tell you why. When you like no hidden fees, you trade anywhere. This thing is so ass. The little fucking um the brokerage or like the options thing that they give you, like not the options, but the options chain and the charts they give you, that is ass. But what you can do is what's it called? You can actually sign up for here and you can actually execute your trades through trading view with this. Um, so yeah, what's it called? Um, for Yeah, and so you can trade free, but you can also, if you really trying to, if you really try to get active on this futures thing, you could get the monthly. And if you're trading a lot, this is really worth it. Like this is such a good a deal. But the lifetime is even better. If you got 25, 20K, thousand, pick up this lifetime, and you're paying so little on commissions. Like you're so wavy, you don't understand. This is like practically free. And I can tell you that if you have 20,000 options trading or futures trading account, you're gonna make more than $1,000. Okay, this is not shit to you. That's all I can say. Um, this is platform I do kind of recommend. Just like no selling, and the reason is because I've used it. That's all I can say. Like I've used this and I didn't put in 25K. I started with 500, then I upped it to 1,500. After that, I usually start around like 5 to 10,000 I put in here, and then I end up trying to take out. Because the thing is I have gotten clapped where I put a lot of money in and they took it all. So I just don't do that anymore. And like I'm telling you guys this straight up, it's not because I think I'm like some super wavy trader and I'm not immune to mistakes. It's just because like the reason why I'm proficient in a lot of things I do, it's kind of like a life hack, is because I'm really quick to make mistakes. I don't care about the money that I make because I think if I made the money, it's not mine, so I'm completely detached to it. So I'm okay with losing it. Like if I made $13,000 that day, I can lose six or seven. I don't care because um, I'm just kind of like built in a way that I've had a lot of experience where I'm a little bit immune to like all the losses I can take. So like I can tell you all this, but I know it's not like that relatable. So that's all. Like I put in a lot of money, but you don't have to put in a lot of money like me. You don't have to lose like me. um, how am I? Oh, I'm using that too. I'm starting with 250. Do you recommend learning options first? What's the minimum amount to get started? Honestly, I'll say this: minimum amount. The lowest I would even bother is like anywhere between 500 to 1.5k. Anything lower than that, like just don't bother. Just trade options and build your account up. And the reason is because you're not going to be ready to stomach a lot of losses with that little of an account. But also, what you can do is, like I said, Um, we don't have to trade the straight indexes. You can trade micros, which is like the version of SPY and SPX, right? Like you guys have traded SPX contracts where they're like in the thousands of dollars per contract. I've seen that, right? But then everyone says, well, you don't need to do that. You say you can trade SPY, and now they're in the hundreds. Now they're in the $50. And then they can, oh yeah, yeah. So that's it. Can I show a trade with the paper trade? Yeah, yeah, I'll hop in. That's what I was trying to do right now. I'm pretty sure like I could actually just like activate like paper trade. Just give me one sec. Uh, I usually just do it on my phone on Weeble, so I don't actually. Yeah, here we go. Okay, paper trading. Connects. Cool. Okay, great. So I have a paper trade account. You guys see my shit? It looks good over here. I can zoom in and do whatever. It looks. All right. How about that? That looks good, right? That's better. Okay. So now here's the thing. We can just see like hey, this is the cool part. Look, guys, it's alive, you know what I'm saying? The stock market is alive after hours. Okay. Options traders don't know nothing about this, man. They're asleep right now, man. They don't know what it's like. Okay. Clowning aside. But clowning aside, what I can do is I can start a position. So, um, what you can do is kind of scroll up here, and there should be a way to actually just take an order. Let me take a position. Hold on. There should be a buy or sell little indicator. Uh, Bear with me here. Oh, here we go. There we go. Okay, so that's why it fucking moved. Okay, the data window is moved. Ah, that's why. Okay, great. Oh, what? They have the indicators here? This is new. Okay, that's so cool. They have I didn't even know this, but they have indicators as like data references. So that's fucking sick. So actually, price is ripping right now, right? So we're like, oh my god, we gotta get in, we gotta get in. So let's say I want to buy one unit here, and the thing is that my balance right here is gonna be 108k. Like I've taken trades on this before and stuff. What you can do is start to you can pre like limit your order where you're talking about like I want to automatically sell or reverse the position at 75 ticks, okay? Or you can do it by price. It's all relative. So I can do like I want to sell it. I want to sell take profit at like 100 points, right? 100 points from this price. So now what I'm gonna do is I'm gonna buy here, and you'll see. Check this out. You see my screen here? You'll see I've bought in. All right, we in here now. So I'm targeting 100 points up. But now, damn, I'm losing, y'all. It's just, oh, okay. Okay, I'm even. We winning. Oh, I'm losing. I'm just fucking with you. But basically, like, you see how it's moving per tick? Every 25 cents, I'm losing $12 here, right? Okay. So what I can do is I can close the position. Okay. You'll see I'm going to take a loss. Oh, L, man. L trade. That's terrible. Terrible. Let's go back in. We got to get back our revenge, right? Now we need 100 of those shits. 100 right now. And we're just going to buy it. You know what I'm saying? I'm changing the time and force just to change the contract and stuff. You don't really have to do a lot of this on your brokerages because your brokerage will default, but I just want to let you know that that's there. And you can also, similarly to when you're doing trading options, you can do those market and limit orders as well. I just do limits because I don't want it to fill it at the market and kind of get filled at the top. I'd rather just get filled at the minimum here. So at this case, let's say I want to buy 100 units this time. I bought now 100. Okay. And we'll see my orders here. So this is working, right? And now I've gotten filled. The reason why it didn't fill before is because I had a limit. So I was waiting for price to approach in there. I've actually gotten filled now. And now, since I have 100 contracts, my profit is up. You understand? I'm not sure if you saw this. But now I got 100 contracts. So it's going to move as the price goes up. There's also a question where it says, do you suggest learning options first before looking into trading futures? Um, yeah, I do. I do. And the reason is because it's way easier to comprehend futures first. And so if you learn options, like you're already like kind of, you know, doing an advanced kind of thing. I think futures is actually way easier to comprehend once you get into it. And also, a lot of our resources, a lot of our trading, a lot of our community does support a lot of options trading. So yeah, so in this case, that's a good question. In this case, how much does each contract make you percents or dollar move? It just depends, right? So in this case, I'm trading regular ES. Now, for every contract, like I bought 100 units. So it's moving crazy, right? So I'm just going to close the position. If you see, if I buy one unit here, I bought one unit, you shall notice that every tick, so every time this futures moves a quarter, I get $12.5. Okay? With one contract. If I buy two more, okay, now my profit and loss is different. It's going to accelerate. I can sell. I'm going to take a loss here, right? I'm going to buy 100. So now, every time it moves 25 cents, look at this. Like, every time it's moving a dollar, I lose like $4,000 or $5,000. So that's how futures can kind of get out of hand. You understand? And so really what you guys will be doing is you guys will not be trading regular indexes that much because what happens is that it's really expensive. Like $50 per 25 cents is fucking crazy. Like that's so much money. So the thing is that what you guys will do is if you have an account under like $10,000, I'd recommend you go through micro futures. You guys see this? You see these micros? So if you click micro, you'll understand that the price is way more forgiving, right? So now, and we're talking like per cents, we're only, look, I'm extending this as much as I can. We're only moving in 25 cents increments. You see that, right? It's only 25 cents. This, so now I'm going to buy in 1 unit here, right? I'm just wait. It's a limit. Wait for me to get filled. All right, I'm not getting filled. So, or wait. Fill, come on, let's go. I want to get a nice entry. I'll give it like a couple more seconds. Like at the end of this candle. All right. I'll fill the fucking ask. Fucking asshole ass trading shit. All right, all right. So you see how the contracts are leveraged now 10 times because it was 12.50 before. Now it's 125. You see how it's like decreased. The leverage you have is way less, right? So if I even buy 100 more, fill me. Okay, so I got 101 contracts, and still I'm only moving like $100 per tick, right? Versus what were we doing on regular index ES? We're moving like $1,000 per 25 cents. So that's like how wild these things go. That's how if you have $2,000 in your account, you have $500 in your account. Well, you risk a little bit too much. You can lose that in one day. You understand? I sat here on paper trading, and I've lost $8,000 already. That could be real life too. So yeah, you understand like how destructive this could get, right? I'll even close this. We'll just keep it at 100K. So yeah, that's kind of like the basics, man. Basics. We can get really fancy. You can put the stops, but this is the same thing. If you trade options with stops and markets and limits, you should understand this. This is not something I can teach you. Where can you see how much they're going to be moved percent? Um, before entering. Oh, so when you look at your order, like let's say you have 1 unit, right? Like you want to do 1 unit, you can just see like how much your risk is. That's all. Like whenever you're filling an order and you type in one, it'll just tell you how much you're risking per unit, right? So in this case, right here, it's $1.25. Okay, but then let's go to the other one. We're not done. Let's go to the other one. What are we gonna see here? How much are you risking per unit here? Okay, this is not. Wait, what? That's not accurate. Wait, what? That's not even accurate either. Wait. Okay. Hold on. I don't know if that's real. The real number here. Is it 25? Is that why? Oh, okay, yeah, that's why. The stop loss here is what's messed up. So you'll see, like, now that I've corrected it, it's just what $12.50, right? Like I was saying. So that's all. Very simple. It doesn't try to like make some crazy calculation like options. Like what you see is what you're gonna get. You know what I'm saying? And that's the beauty of it. It helps you be consistent. When you trade futures every day, like it's so easy to come in and just scoop out $200-300 every day, like or a couple days a week. You might just be up. You might just be up. You're like and for not a lot of effort, for not a lot of time, because you're getting paid per 25 cents. That means like, if SPX moves $4, it's like 20 ticks. 20 times 12.5. It's like $200 already. You know what I'm saying? So, hey, that's valid. $250 every day is like 100K salary. You know what I'm saying? So, I think that's the calculation. But yeah, um, I think that's that. It's like almost 9:55. I think I'll leave you guys with that. You know what I'm saying? I hope you guys like this, mini lesson. Any more questions, y'all? You guys have time, but that's kind of really all I wanted to get into. And also, on TradingView, how I just opened up like that paper trading thing, you guys can all do that right now. You guys can literally start executing paper futures trades with no cost to you right now, just to get a feel for it. You know what I'm saying? That's free, and that'll just make you like that'll just remove any sort of risk or any sort of doubts when you start a new platform, and then you're like, oh, how do I sell? How do I take my money out? You know what I'm saying? You're not fumbling. The reason I'm making that kind of the reason I'm kind of making that assumption is because when I first started this shit, I just kind of went in. Like I didn't do any prep or do any of the useful shit. Like I kind of just like went in blind, and so as a result, I might have incurred more losses than I should have. So that's all. And I don't want to wish that on you guys. So I want you guys to learn from the mistakes I've made. Um, did you already cover paying for data? Any recommendations for brokerage? No. Just like when you pay for real time options data. That's a great point, Trading T. Thank you. Just like a real time options uh, fees and live uh, options change updates. Just like that for Webull and Robinhood, you actually do have to pay fees those subscription fees with your individual brokers as well. Typically, like for trading micros, you'll have to pay an extra monthly. Like, let's say you make a Trade Elevate account and it's free. Typically, you'll pay like $8.99 or maybe $3.99, anywhere between that range, for different exchanges. So, like, an exchange will offer um, ES and other index futures, but then another exchange might offer micros. So you'll actually have to purchase those as well. And when you go on brokerages websites, you're able to see what they offer and what it's going to cost you to buy some specific change. So like people who will trade forex and different commodities, they might end up paying for different data than people who would trade index futures like myself. So that's something that you would need to know. Any recommendations for brokerages? I'm only going to recommend a brokerage for real money that I've used. I don't want to recommend things that I don't use or I haven't had experience with. But the one I have experience with is Tradeovate, and the reason why is because it's free to start. They'll just take a little bit of small, like not small, but just standard commissions on the contract, so it's not like you're losing much. And then also, um, on top of that, they accept wire deposits, so I'm able to get my money in there fast. And then another thing, they pay out. You can withdraw and you'll get paid the next business day, just because it's your own personal account, which I quite enjoy. And then also, um, they actually have an integration that is a little bit more. I think it's an extra $9 or $10 a month with TradingView. And so, what what that means is that you can actually link your TradingView account to that futures brokerages, and then you can just open your trading view in your browser or any app or anything, and use TradingView to trade and execute your trades, which is like pretty fucking lit. Like Robinhood and Webull can't do that, so that's all I can say on that front. I know there's other brokerages that will do that same thing, and maybe there's things that offer better fees, but I just am only gonna recommend things I've used. And I've used that, and I didn't have a problem, so I liked it. Um, like I said, for me, I only really trade index futures, so like for different exchanges, if you really want to get your feet wet, you can just try Thinkorswim, try to use NinjaTrader, MetaTrader, all these big trading brokerages that offer products um, outside U.S. stock market, and odds are you will find some pretty good offerings because the futures market is way bigger than the options market, and so their products are just like way more fleshed out, and there's just so much more material that you can dive into. All right, guys. If nothing else, I'll leave it at that, y'all. Um, it's close to approaching 10 o'clock, but I hope you guys were able to gain something. And mostly, I know a lot of people had questions like ongoing about futures. So I hope I was able to answer that in a pretty good way. Hope you're able to walk away with just an idea of what could work for you. Is future's even right for you? So things of that nature. So yeah, of course, no problem, guys. Have a good night, y'all. I will catch you guys tomorrow. I'll catch you guys in the Advanced Academy. I'm always around and stuff. And I know I did a free training last time or like a walkthrough. I know I would do a follow-up August meeting where we go over last month's setups. That's still um, that's still on the program as well. I just gotta talk to Key about getting a date that doesn't interfere with a lot of the other shit we got going on. Like, we got that calendar and the fucking uh 30-day challenge and shit. So things are just packed. Like we got things like seems like every day. So I'll pick up a good plan for that. So I didn't forget that either. But yeah, that's it, guys. Have a good night, y'all. Appreciate the attendance, and that's it. See ya.